everyone. Thank you for joining us today. Today we have an update with Talisker Resources. The company trades on the TSX under the ticker TSK and on the OTCQX under the ticker TSKFF. Today we have an update with Terry Harbort, President and CEO, and Matt Filgate, VP Corp Dev. Earlier this week, the company announced a royalty financing, and they will answer questions and give us all the details. This presentation will contain forward-looking statements. You can find more about those in the company's presentation on the website. And if you have questions, please input those into the Q&A box at the bottom of your screen. And welcome. Good to see both of you again.
Yeah, nice to see you, Magda.
Hi, Magda. Thanks for hosting us to you in Adelaide Capital. Pleasure to be here.
Yeah. So this week, you announced the $31.25 million US royalty financing with Sprott. Why did the company decide to do a royalty financing?
Realistically, Magda, it comes down to the challenges in the junior equity market and the gold equity markets anyway, with access to capital over the last 18 months. I'm sure if there's any other corporates on the line or any shareholders here who hold shares in other companies, they would have seen that there's been a real challenge to access institutional capital to take our projects forward. Although we've got excellent institutional shareholders and there would have been availability to do equity financing, it would have been at a challenging share price for us, would have increased, would have caused a significant amount of dilution, and the available capital probably would have been a lot less than we've been able to do here. Throughout this challenging time in the last year or 18 months where we've seen a decoupling of the valuation, EV per ounce for junior gold stocks versus the gold price. I think we're all seeing a great gold price, but challenging times for junior equity markets. A lot of companies are choosing just to idle back, not raise enough money just to tick along sort of in a care and maintenance scenario. Our view as a company was to take an aggressive approach and really let's look at ways that we can finance, move forward as we have over the last couple of years, and actually be able to capitalise long-term on challenging markets by taking our project more towards a production stance.
All right, thank you. And can you walk us through the structure of the deal? So it looks like it's a minimum 3%, maximum 3%. What are the minimum, maximum proceeds, and are there any deadlines associated with either?
Yeah, look, it's a fairly flexible deal, and the way that we've negotiated the structure is specifically for that flexibility related to milestones and expenditure that we need to surpass to make the project to the next level. So really the first draw that we have, which is immediate, is just over 1%. It's 1.12%. And that's really to fund us through our resource conversion for the first 2 or 3 years, and start to do development to access those stopes for a first couple of years of small-scale production. The second draw of capital is really for more detailed engineering studies. So figuring out for a more long-term project, what are the steps we have to take, and that takes us up to a 3% royalty. So really what we're looking at, we're taking a different approach to other companies. Other companies look at large-scale startup production scenarios. We're looking at a small-scale startup production scenario. We're looking at staging in, understanding the mining method and the methodology, and staging in our production rate over a couple of years. We're also looking at an off-site processing scenario. So we're not looking at building a large mill, funding a large mill, putting in a processing plant. So we're looking at a more conservative pathway to production than most companies take. And you may ask, or the shareholders may ask, what's the reasoning behind that? And the reasoning behind is that a lot of junior companies fail when they make a transition from exploration companies into mining companies. So we want to make sure we've got the right people in place, that we have mining in a small scale till we understand it well, and really have a small project that's profitable and in a level of operational excellence, and then look over time to develop that into a larger scale project. I sort of got sidetracked on your question. I'll answer the second half of that, which is the third and fourth draws that are sort of 1% each. At present, we're not planning on drawing that capital and burdening that royalty. We'd like to keep the royalty burden low. That's really there for emergencies. If we have something that doesn't go to plan, that we already have that capital lined up that we can draw on and take the project forward.
Got it. Thank you. And looking at the breakdown of the 31 million US, so the initial grant is for a 1.12% royalty for US 7 million. What would these funds be used for, and when do you expect to close this?
So we expect to close in around about a week. I think the 22nd or the 23rd is the anticipated close. Those funds are really the breakdown of that. The majority of it's for resource conversion. So we're planning on about 16,000 metres worth of drilling. Around about 10,000 of that will be underground, and the rest of it will be from surface. It'll be targeting resource stopes that were defined in our last resource. We'll be converting those from inferred category into M&I, and it'll predominantly be in what's called the BK zone. So anybody who's already come to site and visited or paid a great deal of attention to our indicated resource in the resource statement earlier this year, that's the area that we're targeting, that area. We're also looking at some of that funding being allocated to initiating some development in that same zone as well, to be able to access our second and third year stopes. And that's still in that same zone that sits between the historic King and Bralorne mines, but it's in a total new area, so where we've defined that new resource.
Thank you. And then there's a further 1.88 for US 11.75 million. So is the release of that amount contingent on anything achieved during that first work program that you just described?
Yes, it's really contingent on the completion of engineering studies and internal works, economic works, looking at that resource conversion. So we've got to finish that resource conversion work, and then we look at what's the development, what's the infrastructure that's required to access the first 3 to 5 years worth of mining. How do we fit in that mine schedule, and how do we look at a ramp up scenario, starting at a small rate at about 100 tonnes per day, and then gradually increasing that over several years to 300, 500, and so forth. There's a few other contingencies there as well. The second is organisation of a toll milling or an ore sale agreement. As our shareholders are aware, we're in discussions with multiple companies, looking at places where we can process our ore remotely. So we still are very committed to that pathway, and we think that's the best economic way to start up the project without having to go and source several $100 million in capex for our own mill. It allows us to get into production quite quickly at a small scale, well controlled, and then start to ramp that up. We'd also like to finalise some of the agreements, some of the community agreements, particularly with our First Nations stakeholders, being able to move into a bridging agreement, which is an intermediate agreement in between what we currently have, which is an exploration agreement, and a full IBA, which would be something that we'd look to negotiate and finalise if it was economic and feasible to go to full-scale local production.
Got it. Thank you. So I think you kind of answered the majority of what I was going to ask next, which is what is the second round of funding going to go towards? But
yeah,
are there any?
Sure, it's more if something goes drastically wrong. I'm hoping that we have the right management team that we'll be announcing hopefully early next week, and also the right level of engineering, consulting, and support. That we don't have any issues, but there are always unknowns with mining. So we just want to make sure that we have access to that capital if there are some unforeseen challenges with transitioning into small scale production.
Okay, and we have an audience question. So what production rate would you be looking to ramp to by the end of this kind of first stage, if it goes well?
Really, for the first couple of years, we're in a test production scenario, and we'll be kicking off at about 100 tons per day, which is relatively small. If everything goes well throughout the first year, we'd look to transition that to about 300 tons per day. And then again, if all that goes well and we're tracking right, we'd move to 500 tons per day. So at the moment, we've got that planned out over the next 2 to 3 years. If things go well, we may shorten that timeline. Our ultimate aim is to transition towards about 750 tonnes per day. At present, we haven't done the studies to see whether that would be the trigger to bring the processing home, to put in our own mill. So that'll be part of these studies that we're conducting over the next 6 months or so.
Thank you. And are there any pre-specified allocations on the proceeds of any of these portions of the royalty, like so much has to go for XYZ?
No, not really, not defined in the agreement. We know quite well from our budgeting requirements how much is needed for our drilling, what our estimated development costs are, and the lengths of the development to get there. So it's quite well constrained. However, it's not subject to the agreement.
And we've covered the first 3%, looking at the further 2% to the 5% max for a potential US $12.5 million. So is the release of this amount contingent on any milestones from those first two kind of phases?
No, it's if we need to draw on it.
Okay. And is it like an all or nothing, or is it like it doesn't have to be a 2? Could it be a 1 on that?
Yes, look, it's a fairly flexible structure in the deal. We've basically set the first draws up on our budgeted requirements. So the first and second draws are specifically what we need for resource conversion, engineering, and development costs. Whereas the third and fourth draws, the other 12.5, are more for emergency states. So we don't know yet what they are, and we can draw or not draw anywhere along the line. So if we decide after our second draw that we don't want to take the full 1875, then we can reduce that.
Got it. So it almost sounds like a contingency type of.
Yes, it's relatively flexible. At the moment, we're fairly certain that we need that 18,750 over the next couple of years. So that'll be what we're taking at this stage.
Thank you. And there's also a repurchase option. So half of the royalty can be repurchased at a multiplier that goes up with time. So confirming that this is payable in cash, right?
We have the option to pay it either in cash or in a share valuation, up to about just 4.9% of the company. So we have flexibility there. We can use one or the other or both.
Thank you. And in the event of a liquidity event at Bralorne, would this option transfer to any potential future buyer, that repurchase option?
Yes, anyone who is to come in and acquire it, it's at asset level. It's at Bralorne Gold Mines level. So if someone was to acquire the asset, then everything would transfer across with it as is.
Thank you. And residual royalties. So once there is 1.5 million ounces of gold produced, the royalty gets reduced by half effectively. Does this still happen regardless of whether or not there's a repurchase made? Like, is that independent one or the other?
Yes, they're fully independent. If for instance, if we take a 3% royalty now and we don't do any buyback, then it'll reduce to 1.5%. If we take 3 and do a 50% buyback and it comes back to 1.5, then that'll reduce again to 0.75%. So it all depends on when that time comes, where the royalty sits, and we can buy back whatever percentage of the buyback we want. We don't have to take the entirety 50%. We can do 20% one year, 20% another year. It's fully flexible.
How are the gold ounces for this reduction counted? So if you were to toll mill material, does that count? Does the material have to get milled on site? How are the ounces accounted for?
So our expectation when we reach that stage is it will most likely be doing an ore sale or toll milling agreement. If it's toll milling, then it can be paid either as recovered gold, both either in kind or as cash. If it's an ore sale agreement, then it's relative to the amount that's paid for that ore. So it's relatively flexible there to incorporate what stage we're at. Are we trucking to an ore sale scenario? Are we trucking to a toll milling, or are we actually processing our own ore by that stage? So it's fully flexible how that operates.
And does this royalty reduction transfer in the event of a liquidity event as well?
Yes.
Thank you. And you've mentioned toll milling, so we have an audience question about toll milling. Regarding transportation, will it not be difficult getting the 150 tons per day moved to a mill, taking into consideration the road access, and where would a mill be?
Well, there's two ways, I guess, to answer that. But what was the amount? The question, 150?
Yes, regarding transportation, how would you get the 150 tons a day moved to a mill, given where the roads are around Bralorne?
Okay, so in general, we'd be using 50-ton trucks to transport material, road trucks. So you'd be aware of those. You'd see them on any road construction site. 150 tons per day is 3 trucks. So you know it's a fairly low amount of trucks moving the material. We're currently undertaking ore sorting studies at the moment. There's potential with ore sorting to be able to reduce the amount of tonnage that we need to transport. Our current thinking is that might be between a 30 to a 50% mass pull. So we reduce the amount of material either by a third or by a half. So that'd basically reduce it down to 2 or 1.5 trucks at that rate. So it's a relatively small amount of transportation that had happened in comparison to other transport that's already on the road, either by logging or by hydro, which is a large transporter out there. So there's a lot more trucks per day. They're probably doing that many trucks per hour in comparison with what we're adding. There's pretty good road access to Bralorne. Highway 40 goes all the way to the town. So we've pretty well got highway access to transport this to any of the potential off-site processing facilities that we might end up sending to.
And we have another audience question. What cost per meter are you using for development costs, and will mining be owner operated or contracted out?
So I'll answer the second half of that first. At this stage, we're not looking at building a big comprehensive team. So we'll be contracting out all of that development. Over time, if we make the decision to go to larger scale production, so 750 tonnes per day or beyond in several years, then we'd certainly look at building our own team. But at this stage, we'll be looking at using contractors. Might pass over to Matt. He's got all the economic figures at his fingertips, so he can answer the question there on that.
Yeah, absolutely. Yeah, the quotes that we're getting right now range between 6,500 to about 7,000 per meter. That's what we expect. We've got quoted from a few different companies and looked at a lot of previous mining reports. So it's in that range, 6,500 to 7,000.
Thank you. And I wanted to touch on participation right you mentioned in the press release. So there's an option to for Sprott Resource Streaming and Royalty to participate for up to 40% or $40 million in potential future transactions. What types of transactions does this cover? Is it just streams and royalties or asset?
Yeah, no, it's just streams and royalties. It's in the scenario that if we decide to sell another royalty, we decide to sell a stream, then they have a right there to participate up to those levels. The scenario might be that if we buy back our royalty, we might want to resell it at a higher rate once we're in full scale production. So different scenarios like that. There's only very small amounts of secondary metals in the project that we understand at this stage. So I doubt there'd be any streaming deal there. But basically, if we choose to at some stage sell another royalty or some sort of instrument like that.
And there is an existing royalty that covers the area of the 1.7 million ounce resource. Can you remind us of the rate and who it is with?
Yes, that's a 1.7% owned by Cisco Gold Royalties.
And is there a repurchase or reduction option on that one, or just on the new one?
No, only on the Sprott streaming and royalty.
Thank you.
Unfortunately,
got it. And before I kind of ask you a little bit more about your plans for Bralorne, is there anything on the royalty that you think viewers need to know that we haven't covered yet?
No, I don't think so. You've asked some pretty good questions there to highlight it. I think what the key thing to understand for shareholders is it's a great way to raise capital to take us forward in a challenging equity market. The cost of capital is relatively low in comparison to an equity deal of a similar level, and it's a very flexible deal that we can take the capital that we need when we need, and it's flexible to not have a long-term burden on the project because we can buy back up to 50% of it, and we've got the capping there as well that can reduce it again another 50%. So it allows us to be able to not carry a long-term burden on what we really believe is a long-term, potentially long-term producing asset here at Bralorne. We know the veins go very deep. We know there's potential for a large-scale, long-life project. So that was one of the key things in the negotiation, to be able to start out with a bigger royalty that we can manage with high-grade gold, but being able to reduce that royalty over time so it's not fixed for the life of the project for perpetuity.
With this royalty funding announcement done, can you kind of walk us through Talisker's plans for Bralorne and how kind of there's like toll milling and option and then kind of stepwise from there?
Yeah, so really in our strategy, we have 3 or 4 steps or stages that we'd like to achieve. And each of these increases the confidence of the project and builds more potential for cash flow for us. At the current stage we're at now, if you like, year 0, this is our pre-test mining phase. This is basically doing the drilling and doing the engineering work to understand what we want to do in the next phase. And we're currently planning to initiate that pretty soon, probably August. I think we'll be ready to go with some drilling. There will be some underground work required there, development of drill bays, putting in some infrastructure as well. But realistically, most of the development is there, and we'll be accessing and using access to get into those areas to do that exploration work. Some of that drilling will also be from surface, probably be using some of the pads that we've already drilled on, so it's relatively quick. There might be some road building there with that. We'll have to remodel our M&I component of the resource this year, and that'll really form the basis of the engineering studies that we'll want to look at is how do we get access in there. We'd like to start, we have a surface stockpile that we'd like to process first. That's our first material that we'd like to truck. There's about 6,000 or so tonnes there, Matt. That's right?
Yeah, and it's just reading around 5.1, 5.2 grams.
Yeah, so that's actually zero mining cost. It's already sitting at surface, and we're ready to be able to move that material at any stage. So we'd like to be able to process that either before the end of this year or early next year. And then we'd start to look at going into a test mining scenario. And this is really to fully understand how we're going to mine this, how we're going to transport this, how much benefit does ore sorting give us, what types of ore sorting do we want to be using. And the ore sorting doesn't just give us benefits when we want to truck the material, it also can reduce the size of the mill that we may require. So in this test mining phase, and this may be up to 3 years of the test mining phase, we'll be looking at ironing out any issues we may have and gradually increasing the mining rate that we're extracting material at, starting at 100 tonnes per day next year, and then probably going to 300 and then potentially to 500. This also increases our cash flow. And during that time, we can go through the engineering work and any drilling work to look at a larger scale scenario and the economics within potentially 4 or 5 years of transitioning to an on-site production scenario. So there's a lot more work involved in that than there is in just trucking ore. We've got to look at tailings design. We've got to look at paste backfill. We've got to look at waste management and being able to concrete and use a lot of those voids from the 4 million ounces that were previously mined. So there's a lot of understanding that we need to do throughout that test mining phase, looking at how we manage that, how we minimise our surface footprint by using a lot of this underground space that we have. We've also got some testing to do. Some of our shareholders may recall some of the bulk tonnage material that we identified at the Pioneer Zone. Really, we'd like to test and model that as well and see can that be economically extracted and what impact does that happen on a locally processing situation. So is it a larger scale mill? What do we actually need? Is it economic? So really, we're taking this steady, staged approach to really understand the ore body, to really do all of the testing and planning that we need to do before we look to transition to full-scale commercial production in several years' time.
So you've kind of mentioned drilling, some underground development studies. So are all these things you'd be looking to kind of get started on, and work on over the rest of the year? Is that kind of
Yes, we really want to start as quickly as we can. We've got the RFPs for the drilling ready to go, and we'd be looking at initiating that somewhere in the next quarter, either end of July or sometime in August, depending on access to equipment. We do have some cleanup work to do in the exploration drives underground. So we need to fully understand that. There's some rehabilitation that we look to do at the portal to be able to give us safe and controlled access into where we want to do our exploration drilling.
Thank you. And we have one more audience question about the royalty. How expensive is the property covered by, I imagine, the existing royalty? I think what it's asking is whether the entire property is covered by, I imagine, the one that was already in place. And then what Talisker's properties are not covered by a royalty? I imagine it's at Bralorne.
So the whole Bralorne package, 14,000 hectares, is covered by the royalties.
Will you be doing any exploration on those properties in the next 24 months?
At the moment, we really just want to focus on Bralorne, the drilling we have to do there, and the test production scenarios. We do have a drill plan designed a couple of years ago for Congress. Our shareholders may remember Congress sits to the north of the Bralorne mine area. There's just under 200,000 ounces historically there at 9 grams. It was only ever drilled to 200 meters from surface. So we think there's a lot of potential there to build near-term ounces. However, our focus really is on the resource that we've defined, that really sits in the ownership gaps between the historic mines. So very little of it's attached or near the historic development. It's like brand new, very close to surface. So we think that's the best place for us to focus on areas where we don't have to do a lot of development to access areas where we want to test mine.
Thank you. And we have a question about costs. Any ideas yet on the all-in sustaining cost range, including a toll milling agreement, assuming you ramp up to 300 to 500 tons a day? Or if not known, what would a typical toll milling agreement add to a all-in sustaining costs?
Yeah, I can answer this, Terry.
Yeah, we'll let Matt jump in.
Yeah, absolutely. So what we're looking at right now is roughly $60 US per ton to truck. This adds about $180 US to our all-in sustaining costs. So for those first 3 years of trucking, we're looking at about $1,000 per ounce all-in sustaining costs. We'll see that drop off once we go to on-site processing, where we're estimating somewhere between $850 to $875 all-in sustaining costs right now.
And we might have one more question. So there is an amount payable if there are production targets that are not reached in 2026. So does this transfer as well in the event of a liquidity event?
Yes.
And then the follow-up question from the audience on that is there any more details you can give us about that amount that would be payable?
What it really relates to is the projected production rate relative to the internal rate of return of the royalty company. So I can't talk about what those actual figures are because it's confidential with them. But really, what that is a readjustment of the royalty amount. So we've made representation of our expectation of production, and we think that's quite realistic of what we want to achieve. It's actually above we're expecting that in those quarters it will be well above those areas. But if for whatever reason if the gold's not there, then there's a readjustment in that amount. So the royalty payment will be there, but it'll be readjusted based on a reprojected production rate.
Thank you. So it looks like that's all the questions we have for today. Before I kind of ask you about catalysts and news items to watch for over the rest of the year, next few months, is there anything else that we haven't covered that either one of you wanted to mention today?
No, Magda, I think you've covered it all relatively comprehensively. Thank you.
Oh, thank you. And what would the next kind of catalysts, news, flow items, things like that be to watch for over the next few months?
So we've got some a lot of press releases that will be coming out relative to the drilling that we're doing there, developing that production profile, if you like. So there's about 15,000 meters worth of drilling that we'll be kicking off. So good results coming in from that. We'll be looking to bring in a strong and competent management team to be able to take this project forward. There's always some concerns with exploration geologists, as I am myself, taking a project across to production. So we recognise that the team's very important. So we'll be looking to bring in skilled engineers, skilled miners, skilled people on the technical services side to be able to support the transition into production. We've got some good key agreements coming on the slate here relative to our First Nation engagement and also relative to ore sale and ore sorting. We've been working diligently on them over the last few months and hope to be finalising them relatively soon to be able to build that pathway up. We'd also like to be able to truck, hopefully early next year, some of our surface stockpile. It's not a huge stockpile, but there is some good immediate cash flow relative to that surface stockpile. So we'd be excited to get that processed and receive some funds from that. So a lot of really interesting stuff coming out as we work towards the test mining scenario in 2024.
Thank you. Oh, and we do have some more questions coming from the audience. So these seem to be about a potential rollback. So what would the timing be of a potential 5-for-1 rollback? And can you comment on this possibility that was mentioned in the most recent MD&A of this reverse split of 5-for-1 or 1 new for 5 old shares?
Yes, look, we've been a company now for 4 years. We've done an incredible amount of work. We've done 2 major acquisitions. We've done 150,000 meters of drilling at Bralorne. We've done about 5,000 meters worth of drilling at Golden Hornet. We've done large-scale stream sediment programs throughout our entire Spencer's Bridge package and taken that right up to drill phase on a number of targets. So we've done an awful lot of work throughout that time. We've invested a lot of capital, particularly in Bralorne. Now the time's coming as we're transitioning to a potential cash flow positive scenario that we'll be looking to reduce the level of equity deals that we'd want to do. I can't say we'd never do an equity deal, but we certainly want to move to a point where we've reduced the amount of dilution that we have to do. So we believe it's a very good time to look at a share consolidation. Share consolidations are incredibly common here in Canada and in the US. People like very tight share structures with a low number of shares. And when we've seen companies like Skeena or Great Bear do 2 or 3 rollbacks throughout their pathway. So this is really the first rollback that we've done as a company or share consolidation. We are asking for permission from our shareholders to do it as per our articles of incorporation. And we have basically a year to be able to execute that share consolidation. We haven't decided fully on what the trigger for that would be. My inclination is that we'd rather do it sooner rather than later, so we clean up that share structure and can go forward strongly as a company.
Okay, thank you. And one more question before we let you go.
Sure.
Will there be any economic studies related to small-scale mining? What sort of capital spend would be required to achieve 750 tons per day, excluding the mill? So not an easy one before we let you go.
So we do have internal economic studies now, and we'll be looking to beef up those economic studies. We've certainly looked at what a mine schedule would look like, what stopes that we'd be looking to access and mine, and that's really relative to where we can get access close to surface with minimal development. Over the next 6 months, we'll be looking to do a lot more work on that, fully understanding exactly how much development, how much infrastructure, what all those costs are. Matt's been leading the team on with our external engineering consultants, looking at what those economics look like, and they've led our decisions up until now. We haven't decided yet whether we'd put out a public study in the test mining phase. Really, the test mining is to allow us to fully understand the economics of a larger scale operation. There's a split 50-50 with shareholders as to whether they think PEAs and pre-feasibilities are good ideas or whether they think they're bad ideas. We haven't really settled on which way we're going to do, but I can assure all of our shareholders that we'll be doing a lot of that work internally, and we'll just make the decision on whether whether there's any benefit to put that out to market or not in the test mining phase. Relative to on-site production and whether we should go directly to on-site production, I can throw that over to Matt. Certainly, we'd reduced our trucking cost, but there's other processing costs and a lot of CapEx involved in bringing that on.
Yeah, so for the first couple of years of mining, we're looking at about $5 million in development costs, using a lot of existing infrastructure. We cost it out a mill, look at it with 1,500 tons per day, and you're sitting at 250 million Canadian for just that mill. So we don't see much benefit in the first couple of years in the scale of mining that we're looking at, jumping headfirst into that large CapEx. Also, we have a lot of benefit from trucking into a lot of these economic studies, build up our team and transfer that over to profit production.
Well, thank you, Harry. Thank you, Matt, for taking the time to update us on all the news and everything that you're working on. If anybody has any questions that did not get answered, please email either myself, Magda@cap.ca, or Deborah at cap.ca, and we will work to get those answered. Thank you, everyone, and have a good afternoon. Take care. Bye-bye.
Thanks, Magda.
Bye.